Hello, everyone, and welcome to this new episode of the Fundraising Insider podcast, the podcast where we study what's hiding behind the check and we put it inside the deck. Today, once again, we are not just exploring behind the check. We're going to explore a lot more than this. I'm lucky to have Pierre-Louis with us. Pierre-Louis, as you can tell from the name, is French. I think this is very safe.
And
So
Thibaut.
Thibaut and Pierre-Louis, a
Good
very
person.
French-sounding podcast. But what we're going to tackle today has an international reach and will apply to a lot of you out there. So I can't wait for this one. It's again, I feel like I'm saying this every episode where, today we have an atypical profile and it's not your standard IB person who started a tech VC or something. But maybe that's just a reflection of what this podcast identity is, which is bringing people from different horizons. So I'm really glad I get to say it again today with you. And we'll run through very briefly through your career. Usually careers are quite linear. They can have changes, but they're linear. You have a founder that turns consultant and then they move into venture building and then they become an investor. Or you have people, they are in IB and then they go from IB to PE and then PE to VC. Here you have M&A, you have founder, you have an operating partner part as well in pre-seed, and your latest venture, I won't spoil because you'll tell us all about it, which is something, again, completely different. So please, Pierre, tell us, who are you? How did you get to do what you're doing today? And what are you doing today?
All right. Thank you, Thibaut. Happy to share whatever I can share. I'm a bit impressed. That's my first podcast. So I'll try to do my best to be understood in English as well. So I'm 38 years old. I'm a father of two. And I have a background in finance as an investment banker, so what you call IB. And then I turned into being an entrepreneur. So I made more or less 20 deals, advising sellers. So I was advising a founder or a CEO of a company and in his process to sell or to raise funds. I did that like 20 times or so. And after 6 years working for Cambon Partners, which is a great M&A boutique based in Paris and mostly in Paris and London, I decided to become an entrepreneur, and I started two ventures. One that I sold and one that I closed. I had like every possible phases of an entrepreneur, and end of 2023, my father-in-law and the father of my partner Ben were both entrepreneurs and they couldn't sell their company. So both of them decided to close the company down. Ben, my partner, was in charge of closing the company, like his father's company down. It had been like profitable for the last 40 years or so, like 10 employees, and he was in charge of firing everyone. And so that struck us quite strongly, and we started investigating, like digging up, like how come these profitable businesses are not selling? And it turned out that by 2030, in the next few years, more than 500,000 companies will be for sale in France. A bit more with Belgium, where my partner is based. And so we decided to start to launch PurpleShares. So what we do is that we invest in companies that are quite small, from 10 to 100 employees. And then we progressively sell the company back to either the family, so an heir, could be like the daughter, the son, the nephew, whatever, and we help them to buy the stakes, to buy the shares back to the rest of the family. Or if there is no one from the family inside, we also buy out the company and we sell it back progressively to all managers and willing employees. So that's what we do, and then we can further dig down into what we precisely do in terms of consulting.
I want to keep the PurpleShares part for a tad later because there's already so many aspects in your career to explore. There was founding, exit, M&A, the little pre-seed seed startup investment part as well. I'd like to make this first part a summary of your learnings through all of these different aspects. So what is it that you handpicked from each experience? And then how did you combine, and that will be the third part, how did you combine this into PurpleShares? What are the key learnings you brought in, the things that you left on purpose? So let's start with the M&A experience. M&A for the founding public, let's call it, for the typical startupper, is very far. It sounds very far. It sounds like, hey, that's where I could be heading if my startup goes very well. We can do a merger or an acquisition, and this is a way of doing an exit. but that's only a fraction of what it actually is. So can you tell us very briefly what you were doing in M&A? We'll try to keep it brief there, but mainly the key learnings that you took from that experience and that carried on across your career, especially moving down in scale to the startup industry. What is it you picked from there?
All right. So being an investment banker is quite simple. What we do, I was on the sales side. So I was advising founders to sell their company shares. So either fundraising, it's like a minority, or like it's a bit of shares that you sell for equity, or it's like a sell 100% of the capital that is sold to either like an investor or an industrial player. So I was sitting in between as an advisor, in between the seller and the buyer. So what I learned, and the key takeaway, I think David Salabi, who's the founder of Cambon Partner, used to say, we were back then investment bankers. So it's two words: investment, bankers. Investment is like towards people making deals. It's like very people oriented, and a banker
Right.
needs to be quite sharp on figures, good, like analytical, like good in analyzing things,
Right.
a good analytical mind. And so you need to combine the two. And that's a key takeaway from this experience. And I try to keep it now.
It's interesting because in startups, if you were to say the investment was the people-oriented part and bankers the finance-oriented part, the people side is even greater. And the more you go down from Series B, Series A, seed and pre-seed, when you're at seed, the financial part, you virtually have nothing but promises or expectations or wishes. So you're only focusing on the team. So how was it for you, the transition, going in a world where the numbers are there? You have numbers, you have data that backs the revenues for the last couple of years, and you can make calculation. You can create your DCF models or your valuation models, etc. And then you move to the early stage, and suddenly you don't really have any of the numbers. So you have to focus everything on the people. How was that transition for you? The transition from a number heavy game to not having to rely, or not being able to rely on the numbers?
Yes, it's a good question. Working with founders, you always have figures to analyze. So even though you're in a pre-seed or VC stage, you need to analyze the market. You need to analyze the early traction. You always have like early CAC to LTV. So I don't know if I need to explain these ratios, but you only always need to analyze a few ratios to
Right.
explain why it is a good investment. So as an investment banker, we still need to go into details. And it's the same in VC. You need to analyze what makes this project reliable, or what makes this project a good investment. And so there is a bridge in between analyzing and maybe putting like objective things, objective figures or objective characteristics, to analyzing people, and then analyzing figures that are quite straightforward on the market and the traction, for example.
So the numbers don't necessarily come from the same place. They're not just revenues or existing numbers, but it's more about the numbers that you're projecting or the numbers that you're working on, making sure that they are solid, that they come from a reliable source, that it's coherent. So
Yes,
this is why we
essentially.
hear in the early stage more about the story. And people think the story is I grew up in this place and I faced this problem myself. And that's not what we mean by the story here. The story is, how do things make sense? How do they connect together? So
Absolutely.
that's the M&A part. Now, you had the founding time. We'll come back to this a bit later because I want to go a bit, I want to go logical, not necessarily chronological,
Yeah.
with the size and where you were. So there was a time with Otium Capital as well, where there was a VC partner role. And we'll put the Asterion role as well in there, because here we're talking VC. So we went from the larger parts with the M&A, etc. And now we're going down to VC, maybe smaller scale, new learnings, new industry. What happened there? What are the new learnings here? And why did you leave? This is kind of the
Yeah.
conclusion where I'm trying to go.
Yeah, no, definitely. I left Cambon because I wanted to start my own business. So I went into starting businesses, and I started like a software company, which was bootstrapped, meaning that we didn't need to raise capital to be profitable. And that was a great experience that I wanted to do. In parallel of Cambon Partners and this first experience, I I was I became quite close to Asterion Partner, which is a VC, like a venture capital fund focusing on impact investing. Founders are great. They have an amazing deal flow. And so I was an operating partner. I started investing on a few ventures and helping structuring like the fundraising part for them on a few deals. So it was the first combination, a mix of like the transition was I want to be an entrepreneur, like sit on the other side of the table after 6 years and 20 deals at Cambon. And now I want to create, to build something. And that was a transition. And I always had this in mind to invest. And so I had already started investing in VC. I mean, I don't know if you want to mention, I mean, you mentioned Otium. It was like a brief experience of
Mhm.
6 months or so. And like the project aborted. That was interesting, but it was like many things were not aligned in terms of vision and also like some values internally. So I switched to another venture to start.
Well, you always learn from failures because
Of course.
otherwise failing would be boring. And well, failing is not boring. It can be annoying, it can be frustrating, it can have many pejorative terms, but by no means is it boring. So maybe let's focus on, you said that one of the businesses that you created, you sold, the other one had to shut down. Otium had some successes, at least for a time, had some shut down. You ended up leaving the Asterion to go to do PurpleShares. So every time there's a cycle, there's an end. Can you tell us more about the ends? What happened in the ends? What are the key learnings you had from some of those failures? I'll call it failure because there's an easy
Yeah.
word for it, but the end of those cycles, what did you learn from there and what allowed you to step back up, go to the next one?
Yes, I think Churchill used to say success is going from failure to failure. And that's exactly what happened in a few cases. So learnings where, I mean, we talked about the learnings from Cambon, which were amazing. They're still like very valuable right now in PurpleShares. The first venture which did well helped me like to build a product, like a tech product, and also to be a good salesperson, which is always good for any business you run and you start. So it's how to build a product, get feedback from clients, and also how to sell, how to bootstrap, how to be profitable quite fast. So that's a key learning. And in the business that didn't go through, it was a lot of hard work. And I think many takeaways are valid there. I would say probably two. One is about personal understanding. So when you face like a difficulty, you need to grow personally because you're constantly facing like problems. And so you need to solve these problems, go around and try to find solutions quite fast. And so it would kind of like a personal MBA in like personal growth because it helped me to know where are my strengths and where are my weaknesses. And so now I think it helps me every day to see where I should go, where I can add value, and where I should not go, and I should outsource this. And the second key takeaway is about people. I think any kind of project, whatever the size, it's all about people. So you need to respect people. You need to respect the timeline that people need. And that's exactly what we have combined in PurpleShares. So we respect the 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 economic cycles of companies, of markets, and of leaders. And so that's like the second key takeaway. Focus on people and respect these people. Should they be your partner or just like in your network?
I think this maturity aspect that you mentioned when you say you have to learn what you're good at and what you're not good at, is that something that sometimes you see either well, let's say mainly founders, that they're lacking? And if so, how is it that as a founder with the 100 million things I have to do on a daily basis, how can I take the time? What are the kind of frameworks or small exercise or little things that I can do that allow me to get better at this, at understanding what am I good at? What am I not good at? What am I losing time on and I should delegate to someone else?
Yes, of course. I mean, a career is a journey. Should you be like an employee or an entrepreneur, and it's something that you need to build up like throughout time. So it's just a process where you need to ask yourself regularly, taking the benefit of hindsight and saying, okay, what is the key learning from this thing that I did good? What is the key learning from this thing that I did bad. Being in constant like evolution, um, and constantly in practice. I'm doing a lot of sports. You can see like a bicycle just behind, and I do like many different sports.
Right.
And that's exactly the same like mindset. You need to be in a growth mindset, thinking positively, and trying at every step that you do to improve, to refine what you do in order to be better and to go faster. So I think it's just a process and a mindset rather than like a methodology. Like you have so many different things to do and think, to write down or to acknowledge what you're good at
Right.
and what you're not good at. But it's important to stop and to take time. That's, I think, the
So it's a habit that one should take every time you do something. Take a second,
yes,
reflect
it's a
on
habit.
the thing that
Yes.
something that went well, something that didn't go well, and for the thing that didn't go well, why it happened, how can you prevent it next time, and for the things that go well. And I think this is something that people tend to forget, is that they focus on what they did bad and they learn from it, which is great. But if you do well and you don't understand why you do well, then you're not able to replicate it. So even when you do something and it goes well, ask yourself, why did it not fuck up? Like, was it just lucky, or did I align the right sets of elements to make it go well? So always take that second time to reflect, etc. Now,
Yes. Yes.
the name of the mother company behind Fundraising Insiders is Pitch Deck Creators. So we create pitch decks. Crazy, what a surprise. We couldn't have told it from the name. So we do want to talk a little bit about fundraising, about pitching, about presenting. There are probably a lot of differences between pitching for an M&A deal to get funding from, say, Asterion, OTM. Then there is another form of presentation when you're doing PurpleShares. So different investment pots or different financial mentality. What do you present that is the same, and what is different?
The main similarities are the story and the people. That's always about people creating a story. So that's really what you want to express in a very simple way, and in a very credible way. So you want to explain every single steps of the process of what you're doing and every single milestone of your story. Even though like there are bumps on the road, like there is no problem, but you need to have them explained. The clearer, the faster you go to a deal. If some things are clear, there is a deal. Something is unclear, it's most likely that there is no deal in the end. Then the differences are mostly about how do you curate your deck? How do you curate your presentation according to your audience? You need to speak to your audience. My partner, Ben, always say that, like, speak to your audience. And he's right. So you need to tailor, you need to adapt every single presentation, every single deck to what are the outcomes that you really want to get.
So what would be the different outcomes in, well, let's say in your M&A career, you are looking to, well, sell a portion of the business or the whole business. So that's the end thing. If you're trying to fundraise, well, you're also trying to sell your business. And with PurpleShares, you're also trying to sell a business, but somehow they're different. Can you tell us about those intricacies? Because in the first layer, in the first lecture, it sounds like it's all the same. You're selling your business, whether it's the whole thing, a portion of it, you are doing that. But what are the differences?
I mean, in the two first cases, M&A and like as a founder, we are selling. So we are creating a pitch deck and we're selling. So we want to raise funds or to sell the company. So we need all of these equity stories and milestones to be pretty clear.
Right.
Then we flipped the table. We went around and we sat like on the chair opposite. And so now with PurpleShare, we're reading decks. We're receiving information because we invest. We're not advisors. We invest, we buy out companies. And so what we do, we now like analyze and trying to read through the decks. What are the key takeaways? Do we believe in the story? Do we believe in the figures? Do we believe in the people? Do we believe in like the potential of the company? So we're just reading decks. So in that way, that's quite different.
I think I was inaccurate in my question. What I meant is, for a founder that is pitching to Asterion, for example, or pitching to PurpleShares, there are different types of entities. What are you doing differently when addressing one versus addressing the other? That's more
I
what
think
I
there
mean.
is no difference. They're just like pitching,
okay.
like what they want to sell a company. They're just pitching, and that's two different kinds of companies. At PurpleShare, we only like buy out profitable businesses that have been like on the market for the last 10 years. And so it's quite different from a VC perspective, for example, where you want to raise funds for the first time. So it's just different decks, but the process is the same.
Gotcha. We'll come back to this when we go to the PurpleShare aspects. Usually, for our audience by now, if you've listened to all of the episodes, if you haven't, link in either the description if you're on YouTube or somewhere in your playlist if you're on Spotify. Check the other episodes. The way we're doing stuff is first part, exactly what we just did, the career of the guest, the key learnings, etc. Second part is, I always refer to the first part as the restaurant. You come in, you bring your topics, you pick on the menu, you discuss. Well, it's nice. The second part is more like a sushi restaurant. You go, you just trust the chef. So we're going to head into the second part where you trust the chef, and I'm going to ask you a plethora of questions. The idea is to just answer either option A, option B, or yes or no. Very brief, very simple. And then we'll come back on those answers, have a bit of discussion. If you want to change your answer from option A and say, oh, actually, I think option B is better, let me explain why. We'll get to that point. So that's the second segment. And then we leave the sushi restaurant and we go to the theater. And usually we dive deeper on one specific topic, and we try to live through that and get some situations. So it's a more creative element. So we finished the first part of our menu.
I'm hungry.
Let's jump
now.
into the second one. I am sharpening my knives and getting the sushis ready. So let's go with the first batch. We're starting with a this or that, which is very simple. Question, you answer option A or option B, and then we'll get to discuss it. Are you ready to go?
Ready.
Beautiful. So startup investing or startup acquisition, what do you prefer?
Acquisition.
When people reach out to you, would you rather them present a deck of the business or just a call without any support?
Call.
Sales track record or potential market opportunity? What matters most in the deal? So it's proven versus unproven.
It's potential market.
Do you prefer a company that has the certainty to grow to be something like a unicorn, or to be certain to have profitability?
Profitability.
Is it better to sell to your family or to your employees?
Family.
Is it better to train an employee for a new role or hire an external expert?
Train an employee.
Now, specific to PurpleShares, are you planning to expand geographically to new countries or expand within an industry sector?
New countries.
If you were to start a new company, would you go for a large market startup project or a profitable SME with a long-term ownership?
Profitable.
All right. That was the first part. We can take a deep breath. Questions are over. Interesting. Startup investing or startup acquisition. I knew you would go for acquisition. It's a bit of the introduction. PurpleShares. We got it. Deck first or call first? It's very interesting because usually people say, well, your deck is there to get you the first call. Or if you have the ability to have a first call, you present your deck in the hope to have a second call. And here you said, well, forget the deck, we'll just do a call. Can you explain a little bit the mindset behind this? Is it because a deck is too crowded or it leads the conversation in a specific angle, maybe remove some of the freedom? Why did you answer that?
Yeah, because it's all, especially with PurpleShare, we're all about people. So we really want to know who is selling and why, and who is buying and why. And so we need to trust people. We need to trust and to align interests. So that's what we do. We just align interests. Our interests are aligned with the seller and the buyer. The seller is mostly like the founder or the CEO selling the company. He's the owner. And the buyers are either the son, the daughter, the nephew in a family transmission, or like a manager. And so we want to meet these people in order to align interests. And so what matters first is who are the people behind that. Of course, afterwards we read the deck and we make our analysis, but we need to talk to people. That's a key of our business.
Right. Now, we got to the second question, which is related to the fourth one. So we had unicorn potential or certain profitability. You answered profitability. But in the question before, when I asked about the sales track record or the potential market, you answer potential. So it's weird because one is you answer potential once, and the other time you answer something that was more what
because
happened
I'm
in the
not
past.
sure I understood well your first question. It's like sales potential. It's like the
how big it can become.
Yes. So
versus
we're not
how big it has already achieved. So it's more about whether you put more importance in what has been done up to date versus how much can happen in the future and how you balance those.
The thing is that like we don't want to, we're not looking at investing in venture capital. We're not like a venture fund. So we're not looking for unicorns. So what we want is stability and transfer these companies to employees or to the family. And so that these companies remain companies locally in the territories of France, of Belgium. And so we want them to be deeply grounded. So we're not looking for exponential growth. So we look at
Right.
the market, because if we're like on a very like declining market, it's going to be hard, even though we have great people. And we also look for salespeople. We always look at founders or managers that take over, that are able to sell and to be good sellers on their market.
Gotcha.
It's the combination of the two.
Right. Okay. I see what you mean. So it needs to be able to be prosperous, but
Yes.
at the same time, not to the unicorn potential.
Yes, we just want companies to respect their rhythm. So, and these companies have been operating for the last 10 years, and they are they are in between 10 to 100 employees. So
Right.
they have not been like on a hyper growth curve like a unicorn has been. And
Right.
so we don't want to break this, because they're doing like fantastic things. And we want to respect their rhythm, their economic cycle. So we're not looking for G curves. We just want them to constantly grow and constantly be profitable. We will not look at a company which is not profitable.
There was a question in there that I asked about selling to family or to employees, and you said family. I'm going to
Yeah.
keep that in the back
For
of my
later.
mind right there. And we'll come back to it when we go to the PurpleShare segment. First, let's run into the second half of our sushi restaurant. So hopefully in between you had some tea or some of the ginger to clean your mouth. And now
Ginger.
we're going to the second part, the yes or no. So it sounds even simpler, but sometimes being so Manichaean in your answer is where the complexity lies. All right, there we go. Have you ever passed on a deal at Asterion and immediately regretted it?
No.
Have you ever told a founder that their company is just not VC backable?
Yes.
Do you think most pitch decks you receive are bad?
Yes.
Did founding Alex Legal change the way you evaluate founders?
Yes.
Is cold outreach ever worth your attention when you're an investor?
Yes.
Have you ever funded a company based on the founder alone and ignoring everything else?
No.
Do you think VC has a structural incentive problem that nobody talks about publicly?
Yes.
Have you ever changed a no into a yes after a second conversation?
Yes.
Was it a mistake?
No.
Beautiful. Would you rather invest in a company with no deck but great metrics or a perfect deck with average metrics?
Great metrics.
Is fundraising fair?
Yes, it's fair.
We'll see about the definition of fair. And finally, are you having a good time?
Yes. I'm
Beautiful.
starving.
Well, I've been feeding you questions for the whole time. Unfortunately, humans don't feed on questions. Some questions you answered yes very quickly, but they were only the first layer. And what I care about is why you said yes. So we're going to run into that. Passing on a deal and immediately regretted it. It happens. Have you ever told no to a founder? Have you told a founder that the company is not VC backable? I suppose this is also part of the reason why you then founded PurpleShares, because some of those businesses, as you mentioned, they're not made for the VC ecosystem, but they can be made for other ways of having a growth or not even an exit, because in PurpleShares, you're tackling companies that will remain within either the family or the employees. So that one was very obvious.
Different types of investors. So some investors are VC and they look for very specific kind of metrics in companies and returns. And then you have private equity that you call PE. And so they're looking for profitability. And then you have like philanthropy investing, and you have like many other kinds of investors. Many times I'm told, like, I try to be very straightforward and honest. And I tell them, like, well, I think you're not talking to the right people. You're losing your time.
Right. Appreciate the clarity for the sake of all, on behalf of all the founders in the world. I think that I can say thank you for this. Do you think most pitch decks you receive are bad? You said yes. What makes them bad? Because later on we had a question about the metrics and the deck, and you said, well, even if the deck is bad, if the metrics are good, it's still what matters. So what was bad when you said that most decks are bad? What is it that could be
Unclear.
improved?
Like most of the storyline, the equity story, like a continuous stream of information. It's not like a readable story. It's just like a pack of information and like thrown on paper and then deal with that. And so it lacks in-depth understanding and explanation of the story, the bumps on the road, and the trajectory.
Do you think in the construction of these days, people start directly on PowerPoint, or they already have the slides pre-cut? And I'm thinking maybe the way it's constructed, having those elements already segmented, might be the reason for this. Is it a better option to start when you build your pitch deck to just write a paragraph, Just write something that is actually connected, and after putting the separations.
Yeah. I mean, I've never been the best student of my class, but back in college or university, you learn how to structure your thoughts and to dissert. So to write essays, and you need to structure your thought. You make a detailed plan of what you want to write and what you want to, what ideas you want to convey in your essay. So it's fundamental to start with this, and you start on paper. You do your detail like plan, and then you go on your pitch deck, on your PowerPoint presentation, and you start with titles. You need to read the presentation, only titles. Is it readable or not? Only with titles. If it's readable, then go and detail your title. And then you have your essay written down.
Very interesting, quick way of doing it. It's actually quite similar to what we do at Pitch Deck Creator when we have people coming to, or companies coming to us with a project. It's, well, today with AI, you can feed everything you've got on your mind and say, hey, just make something out, and it can do some of it. But if you don't take the time to do the exercise yourself, to build it yourself, and to understand it, then when it comes to pitching, you won't be able to restitute with the same level of clarity. So
yeah, we receive every day tons of AI decks. They're terrible.
Well, hopefully what we're promoting here allows to stir away from this. A very quick detour through the AI part. What do you think AI is for entrepreneurs? Mainly, what do you think AI is great for versus what it is overrated for? So here you're talking about making an AI deck that doesn't really have that connection. You can't really recreate it. So that's on the cons. How about the pros? Where should founder use AI versus where they shouldn't?
Yeah, I think it's great to use AI. AI is great at summarizing, gathering data, and summarizing this data, and then it can also structure the data in a random way or in the way you want it to be formatted and structured. So I think there is a process in learning how to pitch, how to prompt AI, and in order to get the output that you really want to have. If you delegate the construction of something to an AI, it will be like average. Or if you use AI as a member of your team that you precisely brief, then you can have amazing things and gains in productivity.
Do you think it's a good thing that now that everyone has to prompt, back in the days, the only people who had to formulate and understand how to structure a task, how to manage, because that's literally manage. Well, there's the whole human aspect that AI doesn't, but managing is also giving clear information and making sure that the way you set a direction, a task has to be clear. Otherwise people can't execute it. Because everyone does it with AI, you have to prompt clearly to get a good answer. Do you think the development of AI trains people to be better at assigning tasks in a way?
Yeah, maybe it's a training. It really depends on how you use AI, and that's an interesting research subject.
Right. Discuss about one more of these. You were saying, asked you if you thought that VC had a structural incentive problem or a structural problem that no one talks about publicly. You took a time to reflect and then you said yes. And this is exactly the kind of crispy anecdote we're after in this podcast. The things that no one says publicly, but hey, we can say it here. So what do you think is not said publicly about the structure of VCs specifically? Where's maybe a structural problem?
I think it's VCs, but like the whole investment category. Which, reading the press in the US, I've noticed that there are more and more articles denouncing the traditional 220 model for venture capital. So 220 is 2% of management fees, meaning that if you raise 1,000, you will take every year 20 as a management fee to run your business, and then 20% of carried interest. So it's a 20% cut on on the profit that you make out of your investments. And more people speak out loud on the fact that it's a debatable business model, which doesn't really align the risk that investors like LPs take with the risks that investors take as investors. And so that's a misalignment here. And maybe there is a misalignment here, and a lot of literature in US right now And another thing is, especially it's more in the American VC, I saw like over time, there may be conflicts of interest. Like when you invest with one company and then you sell this company to like another fund. And so
Mhm.
it's kind of a unclear path with like information and succession of investments,
So,
which are interesting
so if
to.
not 220, what model is being proposed out there? Where is this transition heading to? Is there like higher management fees and lower carry or higher carry? What are the kind of things that it seems like it's evolving towards?
I don't really have a solution, but I've seen like different models. It can be like salaries and bonuses. It can be salaries only and carried interest. It can be like, especially in the impact world, it can be like a carried interest, which is split in between like performance and performance attached to impact KPIs. So you have like many different models that are being A/B tested on the market, which makes like the future interesting. We'll see how it
Right.
goes.
So it's more about the flexibility of that 220 model that needs to, as you said, you need to pitch to your audience. Here you need to adapt the model to the audience, whether you're an impact fund or you're an AI fund. If you're a pre-seed, if you're an accelerator, then you need to have more flexibility. Interesting. Now we have around 15 minutes left, and I want to deep dive a bit more about PurpleShares. If you go on the website, the key things that stand out is selling your business to family or selling your business to your employees. So it's really about selling. However, you said that it's also about investing. So when does the investing start? When does it end? When does the selling start? And when does it end exactly?
Yes. So what we do, we buy out companies and then we sell them back either to the family, so a family member. And so in that case, we are minority investors. So we want the family business to remain a family business. So we empower the daughter, the son, the nephew, in order for him or her to buy out all of the shares of the family. And so we finance this and we also have a team of 7 specialized in like SME transmission, and especially in all the family issues that you can have in transmitting your family business. So it can be like, how do you communicate with employees? How do you communicate with your family members? How do you deal with, I don't know, the ego of your father? How do you deal with like many things that we handle, and we specialize on this. That's the first
Right.
part. Second part is we invest in like not family businesses. So we call it like adopted family,
Mhm.
which are like the managers. So we create a new association with managers, like managers that are in the business. Sometimes we need to find like a new CEO because there is no CEO in the company, but we have great managers. And so we align interests, as I said before, with these teams, the family and the adopted family. And then the second part of your question is, how do we sell our shares back, and when does it start? So then we sell our shares at a market valuation. So every year we do like a market valuation. And if there is extra cash in the company can buy out our shares, and then we give our shares back to the employee and the managers. The willing employees and the managers, of course, we're not going to force everyone. And the the management, the governance needs to be very clear. So we're not going into a cooperative. We're not like in a system where every single employee has a vote, but we're in a system where every employee has a right to have access to capital, to be de-risked on this in his investment. And we force investments, promote, how do you say, we get managers to have like all of the voting rights, so that we
Right.
have like a clear governance.
And your revenue model is, from what I understand, if you buy their shares, say 1 million, and the business goes well, the market valuation of the company goes up, meaning that every year you get to sell your shares for a higher amount.
Yes.
You're not necessarily selling all at once. So because the more the business grows, the more you make a profit. Do you also have a vision where you incentivize those businesses to become even better? Do you do any operational support on how those businesses can grow further so that
Yes.
your chunk of it grows?
Yes, 2 things. So one, we start selling back our shares like on year 2, and we mostly like we aim at selling about 80% of the shares in between year 2 and year like 10. Then the price goes up with the growth, but also with the debt leverage. It's a main difference with venture capital. As we buy out profitable businesses, we buy out these companies with capital, but also with debt. It's like when you buy out a flat, you put money down on the table and then you get a loan from the bank. So the more you reimburse your loan, the more the value of your investment grows. And then what we do three things. One, we do sales support with tech tools. So we have like a tech team inside of PurpleShares. And so we help these companies to digitize, to have modern tools in order to grow their sales. We can even do like agents, AI agents, for example, to deal with loads of invoices or whatever. Second thing we do, we manage cash flow. So we give access to the managers to a tool where they can have a very clear vision on all of their cash flows of the companies. We aggregate all of the bank accounts and we give them a clear view on what is the cash trend of their company. The third thing we do is that we settle. We implement employee ownership. So we give access to capital to every single employee within the company. And this creates 18% more productivity and 22% more employee retention.
Because employees feel like they have a stake in the company and they need to do good for their part to become good.
Yes, that's our mission. It's a change of mindset. We turn employees into entrepreneurs and they now belong to the same family. They're part of the project and we're sharing more information and we share also profits with them. So that's alignment again.
The first part with the upside of being acquired sounds a bit like a company that does a bunch of roll-ups. Once you get into the mother co, a bunch of processes start to be like streamlined. So for you, it becomes easier. By providing this tech stack, you make those all work with the same system. I suppose it also makes it easier for you, PurpleShares, to follow everyone if everyone is using the same system. So that's very interesting. Now, you mentioned year 2 to year 10. Anyone listening who is in a startup thinks year 10. By that time, they are either completely gone and sipping a pina colada under the coconut trees in a paradise island, or they've started another business because they caught the virus of entrepreneurship. But here, year 10, you're still in the game. So what makes it that those companies are year 10 kind of companies versus a company that has a quick exit? You were mentioning that the growth was more linear. So tell us a bit more about the differences in the timelines and what makes a business qualify for PurpleShares.
Yes, we want to be, we're not a traditional investor. We're not like a private equity. We're not a venture capital. What we do is that we buy out in order to transmit the capital and transfer the company to a new story, a new wave of growth. And we want to be involved long-term. We are like evergreen, meaning that we're not pushed by our investors to sell after 5 years, for example. And so our goal is to have recurrent revenues from a profitable company that reimburse its debt and then serving dividends. So dividends come back to us and they also come back to every single employee being part of the journey. So we're sharing profits and we ensure that these companies will not be sold to either an industrial player or a private equity. We want them to remain great performing companies as they've been for the last 10 years in their local jurisdictions, like in their provinces, towns, locally in the territories.
So there's also a dividend aspect here, which is interesting. You're not just looking at reselling your shares and as the only revenue model. There's also that dividend aspect. In order for the dividend model to work, you cannot be like a VC. You cannot have one company out of 20 that actually happens to work magically and you get your revenues. Where the VC work on a 1 in 20 or 1 in 10 success, you have to have a much higher potential. What is the kind of threshold you're looking at? Do you need 80% of the companies that you invest in to actually make a profit? And can you allow for some of them to fail alongside the whole process? Or is it maybe 50% need to survive and 50% can die? Because that's the math a VC make. A VC makes the math that even if 10 of them die, but one goes to unicorn, good for them. For you, it's different. So what is the difference and what is the kind of math you're doing?
Yes, of course. And that's why we have like strict criterion in selecting the deal flow. So we want companies that have been operating for at least 10 years so that they have like a network effect around them.
Mhm.
Second, we want companies to be profitable, like a non-profitable company for 1 year or 2 years. Like we're not looking at this business. It needs to be stable. Third, we need to have like above 7% EBITDA. So 7% like operational
Yeah,
profit
yeah,
from the company, quite stable as well, like growth perspectives, like on a market which is not too volatile or
right.
too risky. And so in that regard, of course, we try to have as little failures as possible. And so we can have failures. It can happen. We can have like extraordinary like growth perspectives because like
Mhm,
we lit up like a fire with aligning all people and like all managers and employees.
mhm.
Um, so yes, it's by selecting carefully all of the companies, and that's also why we have technological tools inside the company to help us analyze better these businesses that we reduce
Let's
risk.
let me make my last question a bit of a bridge, and I'm not sure it's something that you were anticipating, but how can if I'm an investor, say a VC, maybe a bit later stage, is there any value for me into actually looking at what PurpleShares is doing? And here's the idea behind it. If those businesses are great at what they're doing in their own niche, they could be a good addition in a roll-up for a
Mhm.
business to grow from Series A to grow from a niche to adding that knowledge, and then that's the kind of thing they needed to then explode and become a unicorn. Is that something that you're also looking into? So not only selling the company back to the founder, but looking at where can this company that's great at what they're doing in their own niche can be plugged in a bigger business or in another business, and with a fusion, with the synergies, actually explode and become massive. Is that something you're looking into as well?
In one way, yes. So we can help companies we invest in to buy out more companies and to become a bigger company. That's what we do. And we're quite good at doing it. And we only do it if the new CEO wants to do it.
But that's
If he
for the
doesn't,
company to buy out. So that's for the companies
exactly.
that are under your wing to do
Exactly.
that. What about the opposite?
I was about to say
All
that.
right, gotcha,
And
gotcha.
so
Sorry.
that's what we do. And we're okay and fine to do this. We don't only do this. That's like not our focus, but we can do this. What we don't
Right.
do is to sell these companies to industrial players. And that's the case you're mentioning. Like another company which is bigger in the same industry, that's an industrial player. And we don't want to sell these like small businesses to industrial players. That's what most private equity people do. That's not our mission. What we want is to give back to employees, give back to management, and to help them grow as much as they can. Otherwise, we would only have big companies or big international players willing to
Mhm.
grow big in France, in Belgium, in Europe, and that's not what we want to do with PurpleShares.
So it's more about your vision. But is that something that you scout early on? I'm aware of the time. Is that something that you scout early on when you get those companies and tell them, "Okay, what is your vision? Do you want to remain independent, or are you trying to get your company acquired through an M&A deal? Maybe not a unicorn deal, but maybe in a roll-up." And if they tell you, well, yeah, we believe that we can be acquired by XYZ because we have an expertise that they don't have, then you say, well, no, we don't touch to that.
Yeah, we don't touch to that if the intention is to make a coup. That's to make
Okay.
like to do a quick win. That's not what we
Right.
want to do.
Okay.
We stop there. Then we know that life is long. We're long-term investment. Like in
Right.
10 years, things can change, and so we will not block something that the founder and the management and
Right.
the team
Okay.
like really wants to do. If
You're open to
the
it,
effort is
but the thesis remains long-term.
Yes, exactly. And we want to be
All
very
right.
clear on our intention from the very start. We want to be straightforward and clear.
That's what
We're
you mean.
people focused.
Perfect. There. Thank you so much for sharing all this wisdom. Maybe something a little bit outside of what we usually do, but it's interesting to hear those different types of funding for companies or for founders that think, I'm going to go to get VC money. And wait a minute, VC is not the only thing out there. So it's very interesting to hear what a business can look like at the inception, but also in 10 years, because the businesses need to have this 10-year filter and how you want to take them on forward. So that's very nice for especially founders that want to build a legacy. Selling to the family is interesting. So again, thank you for everything. Do you have any last words you want to leave us with? A last advice or any cool projects you're working on? Any last word you want to share?
Well, thank you. I think there is a book which is quite nice for entrepreneurs willing to start their journey. It's called De la stratégie en entreprise. So Strategy for Companies from
Right.
Xavier
Okay.
Fournier. He's a great entrepreneur in France and a great leader. It's a great approach to market strategy and how do you want to approach your market. And maybe another book, which is written by Loïc de Gromard, about his life as a CEO and leader of Glass, which is a French company. It was a turnaround company, not profitable. And then it grew over time to being 4,000 employee worldwide, leader in producing glass bottles like the Vodka Absolute bottle. And they developed tremendous growth thanks to employee ownership, transparency, alignment with all of the employees. And so it's called Souffler le feu sacré. So it's like to blow the
The
sacred,
sacred flame, the sacred fire. Okay.
exactly, sacred fire.
Beautiful.
So these two were great add-ons to my understanding of strategy and how can you align people to great growth through employee ownership.
Beautiful. Thank you for this last bit of wisdom, which is considerable if it's the size of the book we're considering here. For
They're
our
short to read.
audience, well, it depends how passionate and how fast you read. So for our audience, once again, thank you so much for having listened to us. If you want to see our beautiful faces, as always, you can head to YouTube. If you want to share the format in a more digestible way, we are also making shorts, reels, etc. So that makes it a lot more, we try to synthesize exactly what you just said. All of the learnings from the episodes, all of the segments, the smart bits. So please check our media. Of course, please follow Pierre on LinkedIn. Check out PurpleShares. If you know anyone as a company is trying to share, is trying to sell it, or they're thinking of passing it down to their family, to employees, give it a look. If you're just curious about it, listen to the episode, check Pierre's network, go on the website. And for everyone else, we will hear you in the next one. Thank you so much, Pierre.
Thank you, Thibaut. Cheers.
Cheers.
Have a good